Anil Rai Gupta, the Joint Managing Director of the company, joins us now to talk about that. Mr. Gupta, good morning and thank you for taking the time out. Where are you feeling the pain the most in terms of segment-wise performance, and what was the key reason for cutting the revenue guidance this time?
Well, first of all, Lata and Sonia, congratulations on your 15th anniversary.
Thank you.
Thank you, Mr. Rai.
On the CNBC 15th anniversary. We started off the year with a very good first quarter with almost a 21% growth, and a lot of it coming from the cables and wires segment. And at that time the feeling was that this could percolate down to other product categories, or this is a more of a pent-up demand or a case of low base last year. It tapered a little bit in the second quarter, which was down to about 16 to 17%. And also in the third quarter, we are not seeing much uptake in the demand. So basically, the initial euphoria just after the elections were over, that we could see that, we were seeing that a 20% growth we were achieving could be possibly, continued for the entire year. That we are not seeing at the present moment. So it's not something which is too much of a pain point at this present moment. It's just the fact that whatever reforms the economy is talking about, normally it would take a little bit more time to come, the effects to be realized on ground. And that's what we are realizing. Last year we had a 10% growth. We are definitely seeing a better year this year, but maybe the kind of effect that we wanted to see after the elections, that is not evident as of now.
So you did mention that 21% growth is what you saw in the first half of the year in cables and wires. In the second half, how much do you think it could slow down to?
So it's difficult to say, but at least we do feel that there is a little bit of a tapering down on in the overall sales growth. So both in cables and wires, as well as consumer durables, lighting. So we're not seeing that kind of a growth that we saw in the first quarter. Difficult to say, put a number, because we still have another 4 months left in this year. So let's hope for the best, but it's just that the growth is better than last year, but not as good as in the first quarter.
Is this entirely a domestic worry, Mr. Gupta? What is your export or external market exposure? And I would assume they're European markets. How are those markets doing?
Well, in fact, the European markets are doing better this year. We are seeing a growth in Sylvania revenues this year, and we are expecting a 5 to 6% EBITDA margins, operational margins, still in the international markets or in Sylvania margins, and I think we'll be able to achieve that. So except a few Latin America issues of foreign exchange and all that, but still we are expecting the operational EBITDA that we had envisaged.
Okay. What is the percentage split between external and domestic markets?
Almost 60% we get in India, and the rest 40% comes from international.
And it is that 60% where you're seeing pressure of demand?
I would say that it's not as good as in the first quarter. We would definitely hope to achieve better results in the coming quarters, but at this moment it is, as I said, better than last year, but not as good as the first quarter.
Okay. So what would the blended margins of the company look like by the end of FY15?
Well, we still hope to achieve 13 to 13.5% EBITDA margins in the coming in this domestic market. So there we don't see much of a problem. We will continue to invest in our brand building activities and distribution enhancement. So we are investing for the future. So I don't see any major issues in the domestic market in the medium to long term. This is just a short-term, I would say, pressure points at this moment. And in the European markets, in the international markets, we are still expecting 5, 5.5, 6% EBITDA margins.
Okay. Mr. Gupta, there was talk that the fall in European bond yields means less earning in Sylvania, and therefore some pressure when you have to pay out pensions. Should we expect some pressure on the P&L because of that?
Well, it's a book entry because, as I said, operational EBITDA would continue to remain the same. We do not have to pay out pensions, as of now. This is more of a book entry and a non-cash item. So yes, if the high bond yield would mean a higher provision for pensions, that could affect the P&L, but it is a non-cash item.
Okay. Can you just give us, throw a little more color on where you're seeing the demand slow down quite a bit? I heard you mention cables and wires, but what about the other segments like lighting and fixtures? I mean, in the quarter gone by, your switch gears business, your lighting and fixtures business, even your electric consumer business, did quite well. I mean, you managed to see at least a 15% growth in revenues. But for FY16, which is the segment that you're worried about the most?
For FY15, no, this is something which we are seeing in overall. FY16 we are not really too concerned about. I think this is more of a short-term issue. As I said, probably by the end of the financial year or the first quarter next year, we will start seeing the uptake again. So, as I said, this is not something which is division oriented or sector oriented. It is the overall slowdown in the housing sector, which could affect the demand for all our product categories. But I think this is more of a short-term thing because we have seen very good growth in the first and second quarter. So we are just being a bit cautious in the third and fourth quarter, and let's hope for the best in the coming months.
This is an industry, is it an entire economy level thing that you are noticing, or is it specific to some of your products?
No, I think it is an overall thing. It's more, not really specific to any products.
No, I'm just wondering, therefore, whether we should expect other consumer and industrial companies to also lower their expectations from the second half. You would think that's possible?
Well, I can only say that, because of our branding efforts and distribution enhancement, we are definitely looking to a continued increase in market share even during this period.
Actually, you have seen higher amount of ad spends as well in the quarter gone by. With a slowdown in demand, do you think you'll have to increase ad spends, and would that put pressure on margins just in the near term?
So I guess our product is such where it's not really dependent upon the sales are dependent upon the amount of ads that we come out with. It's not really impromptu kind of a demand. It's or impulse kind of buying. It's more related with the fact that we want to continue to build a brand for all our product categories, and that there's a long-term strategy in brand building than very quarter-oriented strategy in brand building.
All right, Mr. Anil Rai Gupta, it was a pleasure speaking with you. Thank you very much for your patience and for all the details.